Okay, we are now looking at marginal and absorption costing. Now, the absorption costing is a costing where we account the full product cost. So this absorption costing is a full product cost. Then marginal costing only considers the variable cost of a product. So this one considers only the VC, the variable costs of a product. Then the absorption costing considers the full product cost of a product. So this starts to define marginal costing and absorption costing system. Okay, so now when we look at the full cost, is it under absorption costing, and then marginal costing deals with the only variable costs. Okay, so under marginal costing, we only consider the variable cost of a product. The absorption is the full cost of a product. So in marginal costing, we consider contribution, a unit, while in the full product cost, which is absorption costing, we consider the gross profit of a product. Okay, so now getting down to the contribution concept is for marginal costing, which is MC. Marginal costing is for where you, this is where you find the contribution. Okay. What happened? Check it. Okay. So here under contribution concept is for marginal costing. And then we can also do the profit statements for both under absorption costing and under marginal costing. So we can do the profit statements under the absorption and marginal costing. This one is not cumbersome. You'll be able to understand thoroughly. Now, getting down also to the advantages and disadvantages of marginal costing, and then merits and merits of absorption costing. Now, if we go to the definition of marginal costing, this is a costing that deals with variable cost only of a product to find the contribution. So that's why we have the concept of contribution. So there is no gross profit in marginal costing. So there is only the concept of contribution, which is the difference between the selling price per unit. So contribution per unit is equal to selling price per unit minus the variable cost per unit. So this is how we get the contribution. So this is the difference that is in there. So this is variable cost per unit. So this is how we find the contribution per unit in marginal costing. There is no gross profit. I have to overemphasize here in marginal costing. There is no gross profit. There's only contribution. Then from contribution, we find the profit aspect. All right. But in absorption costing, so if you look at marginal costing is the part of the cost of a unit or product or service which would be avoided if the units were not produced, or which would increase one extra unit of production. So meaning we're talking about the production. If the more you produce, the more you incur, the cost that you incur. So variable costs will increase according to how many units we're producing. So it varies with production. So in marginal costing, we only consider the direct material involved in production. These are some of the examples of variable costs. The direct labor is some of the, this is another type of variable cost in marginal costing. Then variable production overheads, all these, they fall under marginal costing. We have no fixed cost here as we are finding a contribution in marginal costing. So marginal costing is an accounting system in which variable costs are charged to cost units and fixed costs okay, of the period are written off against the total contribution to find the gross profit, that is to find the net profit. So after we find the contribution, then we can knock off the fixed cost in order to find the profit, the net profit. Okay, so this is about what this is all about, the marginal costing. So it deals with variable costs to find contribution. Then we can get into after we subtract the fixed cost, then we get the net profit. Okay. So now under absorption costing. So this is just the overview of marginal costing. Of course, we'll get into details of this topic. Okay, so let us now get into absorption costing. Okay, so absorption costing, under absorption costing, both variable and fixed costs are absorbed into cost of a unit. So we consider both the fixed and variable cost, right, to find the gross profit. That is it under this one. So our gross profit, the GP, is equal to we have the sales minus the cost of sales. So I say this one is just similar to the financial statement for preparation of the income statement. It's just the same concept we use under absorption costing. So sales minus cost of sales, we get the gross profit. So in the marginal costing, there's no gross profit. There is only contribution. So we have no gross profit, but we have the contribution. All right, so this is a major difference here. But in both cases, we have the net profit. Okay, so in both cases, we have the net profit. So this is under marginal and absorption, where we look at the distinction here. These are the difference, but the major difference is where we look at the gross profit in the absorption costing, and in marginal costing, we look at the contribution per unit or contribution. So when you just say contribution in marginal costing, contribution is equal to total sales minus cost of sales. So when you look at contribution, this is in marginal costing. So contribution is equal to total sales minus the cost of sales. So contribution, in fact, we can even say total contribution is equal to, so here we can say total contribution. So total contribution is equal to sales, okay, which is the total sales. Okay, so it's sales here minus cost of sales, minus the cost of sales. So this is about how we get cost of sales. Okay, so this is how you get the difference here between this is the cardinal point as we look at an example, a detailed example, a comprehensive example, an exam equation type. When we look at that one, you'll be able to understand the difference here where we are looking at these contributions in marginal costing and gross profit in the absorption costing. So absorption costing looks at the full product cost. So an example, we can have a simple example here. Product cost under marginal and absorption costing. Let's look at this one. A company produces a single product and has the following budget. Sales or selling 10,000. Then we have direct materials, 3,000 kwacha, direct wages, 2,000, variable overheads, 1,000. So these three already, they constitute MC, which is so this is MC, which is the marginal costing. The direct wages, direct materials, variable overheads, these three, the summation of these three is a total of the total variable costs. So the total variable cost would be 3,000, 2,000, and 1,000. That would be our total variable cost. Now, let us get into the selling, or the sales is 10,000. So if you want to find the contribution already in marginal costing. Here, we can just get the selling of 10,000 minus the total of 3,000, 2,000, and 1,000, because this is the total variable cost to find the contribution from the formula here for marginal costing. So meaning our contribution here will be the difference between the 10,000 minus the 6,000, which would be 4,000. Now, we'll get in touch. We get it down here. When we get into absorption costing, we are going to consider the fixed cost. So fixed production overhead is 10 million per month. Production volume is 5,000 units per month. So we can find the fixed cost per product or the fixed cost per unit, because here they're saying a company produces a single product, which means one unit is a unit. So this is for a unit, because they are saying a company produces a single product, which means one product, one unit, and that's this one. All right, so meaning the direct material per product is 3,000, direct wages per product is 2,000, variable overhead per product is 1,000. So we can find the total variable cost from there. Now we can get into the fixed production, which is 10 million. So meaning the fixed cost, so the fixed cost here per unit is actually going to be equal to 10 million, which we have here. So our 10 million, then we should divide it by how many units we've produced in that month to find the fixed cost per unit. So it is 10 million kwacha. Then we divide by 5,000 units. So 5,000. So 5,000. So we can find our fixed cost per unit. All right. So now calculate the cost per unit. Calculate the cost per unit using, okay, to be used for a stock valuation under absorption costing and under marginal costing. So for absorption costing, absorption costing considers the product cost in terms of the variable cost per unit and the fixed cost per unit of a product to find the total cost per unit of a product. So total cost per unit of a product, our TC per product, we know our total cost is the full cost where we're looking at the variable cost and then plus the fixed cost. So this is it, how we get and this is what is important, because in every organization, we have to look at the full product cost in terms of the variable cost and the fixed cost of the product. We aggregate these two, the variable cost and then the fixed cost. The total of these two will give us the full product cost, because we cannot forgo the fixed cost. So now here we can divide, meaning that our fixed cost per unit is, we are going to say the fixed overhead is 10 million per month for a production volume of 5,000 units per month. So we can divide here and get the fixed cost per unit, because the 10 million kwacha was for the production volume or units of 5,000 units. So we can find the fixed cost per unit of a product, which is actually 2,000. So this is the full product cost here is 8,000. So meaning we are considering both the variable cost, direct material, direct wages, variable overheads, and absorption fixed cost per unit, which is 10 million divided by 5,000, which is 2,000. So the sum of these, that is the full product cost per unit in terms of absorption costing. All right, so meaning as we find our GP here for this one straight away, because like I mentioned that in absorption costing, we need to find the gross profit, not contribution. So here are going to have the 10,000 that we made and the sales. So 10,000 then minus 8,000. So 10,000 minus 8,000. Then we are going to find our the difference there, which will give us the gross profit in terms of this one, the absorption costing. So meaning here our gross profit in this case will be 2,000. This is 10,000, which is the sales from that example, from that question. And then we have that one. So meaning this is it, our gross profit in terms of absorption costing. All right, because the sales, like an example I mentioned here to say sales minus cost of sales, that is under absorption costing. So that's why we have considered, we didn't only consider these direct material, direct wages, variable overhead. We had also to incorporate the fixed cost per unit, which is a 2,000. And then we found the total product cost in absorption costing of 8,000. Now, getting down to marginal costing now. Marginal costing, we are going to find, first of all, our direct material of 3,000. Then, of course, we know the direct labor or wages, okay, or direct wages is 2,000. And then getting down to variable overheads, which is 1,000. The sum of these, this is the total variable cost, total variable TVC, total variable cost. Now, this is only per unit of a product. All right. Now, we can find the contribution here. Okay. So contribution, okay, in this case is going to be the sales. So contribution, so that's a major difference here, like I mentioned. So our contribution here will actually be going to be the sales, or the selling price, or the total sales, which is 10,000, then minus 6,000. So 10,000 minus 6,000, the contribution in this case will be our 4,000. So this one minus 6,000, then you are getting 4,000. That is it, our contribution per unit. So this is 4,000. So this is the difference between the absorption and marginal costing so far. Okay, that's like I mentioned. So our contribution here will be 4,000, but our gross profit here is 2,000. Now, this for absorption costing, it is significant because you have accounted for every other cost. Okay, because for a contribution, it may be misleading.
I mean, I'm not understanding why getting.
Yes, please.
Why are subtract on the fixed overheads? Are you able to come again?
Okay, so the fixed overheads, we are saying is 10 million, not so. So you can see a fixed overhead is 10 million per month. Yes, and then the production volume is 5,000 units per month. That is the total production units is 5,000 units per month. So if we are to find the fixed cost per unit, we will divide the 10 million divided by 5,000. So you're getting a 2,000. Okay. So this 2,000 is our fixed cost per unit in this given month. All right. Yes, because the fixed cost of 10 million in that given month was according to the how many units they produced in that month of 5,000 units. So we had to find the fixed cost per unit, one unit. So the 10 million was equivalent to 5,000 units. So now for a unit, what was the cost for one unit? So that's the reason why we had to divide the 10 million by 5,000.
Okay.
All right.
Yes.
I'm sure you've gotten it now.
Yes.
Okay. So now this 2,000, we should not include it as we look at the total variable cost. No, total variable cost are costs that vary with production. So that's why in the marginal costing, we did not account for it. So we only accounted for the direct material, which is the 3,000. Okay, so material will vary according to how many units you are producing. Then the wages, direct wages, will actually account for how many units you are producing. So that we, how many people are going to pay based on your production. And then variable overheads, all these are variable costs. So these three, they go to marginal costing, because marginal costing deals with only the variable cost of production in order to find the contribution. So the 2,000 that we have actually found here, we need to incorporate it to these figures that we have. We need to add it to these figures that we have here for direct materials of 3,000, the direct wages of 2,000, and variable overheads of 1,000. We need to account for it as we look at the absorption costing, because absorption costing, it is a full costing that considers both the variable cost and the fixed cost of the product. All right, so now this is how we found for the 2,000 we found we had to add it here to find the full product cost per unit. So here there's a full product cost per unit. So consider everything, the direct materials of 3,000, the direct wages of 2,000, the variable overheads of 1,000, and the fixed production cost per unit of 2,000. Then we are getting the total product cost of 8,000. That is in absorption costing, full product cost. So if you understand these basics, as we go to a comprehensive example, it will actually be very easy to follow through. All right, so now.
So is it okay to say that when finding the absorption fixed overhead, you divide it by the production volume?
Yes, you are right. So that is how we find all the time. So we try to find the production for a given month. So if I've given you for the entire year, if it was for the year, then if they say fixed production of 10 million, if it was for the year, you divide it by 12 months for you to find what's the fixed cost for 1 month. All right.
Yes, sir.
So you divide the 10 million for the entire year. If it was for the year, if it was a 12 million for the entire year, then you divide it by 12 months so that you find what is the fixed cost for a given month. All right. So now this, because we're looking at the total product cost per unit. So we had tried to aggregate the direct materials, the direct wages, the variable overheads, and then we had to incorporate the fixed cost per unit of 2,000 to find the full product cost, which was 8,000. So to get the gross profit, we had to say the 10,000 minus the 8,000. Then we got the 2,000, which is the gross profit. All right, in terms of absorption costing. Marginal costing, the total variable cost was 6,000. You don't consider the 2,000 the fixed cost. No, for you look at the total, the sales minus the total variable cost of sales. All right. So meaning our 10,000 here minus a 6,000, you're getting a 4,000. So this is the contribution as per this example, the first example that we've looked at. All right. Yeah, we can now get into a comprehensive example. Let's get into a comprehensive example. Okay, so why contribution is significant? So contribution is an important concept in marginal costing. We are looking at changes in the volume of sales or in a sales price or in variable cost will all affect profit by altering the total contribution. Okay, so we just have to know the contribution aspect simply means we are looking at the total sales minus the variable cost of sales. All right, so you can know how you can manipulate the variable costs. Maybe you cannot hire workers so that because you don't pay them wages, you can hire a few workers. You can know how to manipulate the materials how you can actually sort out or minimize materials, because the direct materials, all these, the components of variable costs, materials, the labor, and variable overheads. Okay. Now, let us get to the format of the marginal costing statement. Okay. So marginal costing statement, we have the sales, which is their opening stock. Whatever units you have, you multiply by the variable cost per unit. We'll get this value here. And then variable production cost, you get it. You also look at the variable production cost, everything variable. Okay. So closing stock at variable cost, we have gotten that one. Then we get the variable production cost of sales. All those supposed to be variable. You understand as well. We look at an example. The variable selling expense is supposed to be there. Then you have the total variable cost of that one. Then we can subtract these two. You get the figure, which is the contribution. Now, contribution minus the fixed costs, and then minus the production, okay, and then minus the selling and administration, then you can get the profit or loss. So this is under format on a marginal costing. All right. So these notes will be there as we look at an example. We can even refer to the notes, and then where there will be any other issues, we'll be able to actually explain again. So now let us get into format for absorption costing. So absorption costing, sales, you record the sales here. So sales, then opening stock at full cost, but here it was opening stock at variable cost. That's a difference here. All these are at variable cost when you're getting down to the contribution. Now, under absorption costing, we are getting down to the full product cost. So we are simply saying it's the sales minus the opening stock should be at full cost, which is the full cost, meaning that we account for both the variable and fixed cost. Then production cost also should be at full cost. Closing stock should be also at full cost, meaning that both the variable and direct cost of production. And then we have the cost of sales. Then we can subtract these two to get the gross profit. Like I mentioned here, it was contribution. All right. So we subtract A and B, we get the contribution. Then here we subtract A and B, we get the gross profit. Then here we should add over absorption. When it's a negative, meaning that it is under absorption. Okay. So we have, if it is a negative here, it is under absorption. All right. So subtract there. Then we get variable selling sales, we subtract there, and fixed and admin, then we get to the profit or loss. So this is just about the format as we look at these costing, the difference between the marginal and absorption costing. So the other one is full product cost, which is absorption costing. The marginal costing is just for variable costing, deals with variable costing, variable costs to find the contribution. Here there's a gross profit. So that's a difference between these two costing. All right, so now we can also get to here an example. There are these other additional notes that can be there. We can also look at where we are looking at marginal and absorption costing. Okay, so these are just about the same. So here we have the sales. So this format, the other format, if it was not okay, you can still use this one. Sales, we have that amount there. Then opening stock at variable, all variable here, variable expense. Okay, add the variable selling expense. So closing stock. So this is a standard format. Sales, opening stock at variable. We have that one. Then we add variable production, okay, which is that one. The total production, which is that one. Then the closing stock at variable, that one. Then add variable selling expense, that one. We have got total variable cost of sales, we have that one. Then we can have contribution, which is that one. Then the fixed overhead, all right. We have, so this is if you need to understand the full statement, not on the horizontal one, so we can look at this other one instead of the other one, which is here, which is on the vertical one. We can still look at this one here. So fixed costs, we have that fixed cost there. Then the fixed, all these are supposed to be subtracted. So fixed selling expense is supposed to be subtracted here. Then we get the net profit. So here, there's aspect of contribution, which is a cardinal point that should be there. This is a format for marginal costing statement. All right. Now we can get to the other. So absorption is costing statement, which is a full costing. If we're looking at full costing, which is absorption costing. We have the sales. We have that one. So sales figure. That is the preparation of this one is just similar to the way we prepare the final accounts, which is the income statement or the trading profit and loss account, as we look at the financial accounting part. So this is the costing part. So under absorption, full costing. So we will put the opening stock should be at full cost. The production should be also at full cost. Then total production should be there. Closing stock should also be at full cost. Then you have the cost of sales there. And then the gross profit. So this is the distinction between the two, because this other one is talking about the contribution, which is marginal costing. Okay, so this one is talking about the contribution. Then the other one is talking about gross profit. Then you add over absorption. Okay, so over absorption you should add. All right, so if it is over absorption, you add over absorption. All right. So what add over absorption, that is the absorption that is beyond budgeted, that is of absorption. So you understand that. I look at an example. Then variable selling, we subtract this. Variable fixed selling, we subtract. Then we have a net profit. So in both cases, we have the term net profit, but the other one has the gross profit. The other one has contribution, which is just. So now let us look at this example. X Limited commenced business on 1st January. This example is coming from the same comprehensive example here. We're saying X Limited is just the same. We are saying a comprehensive illustrative question on marginal and absorption costing. All right, so X Limited commenced business on 1st January, making one product only. All right, with the following costs. All right, so we can have our direct labor is 5,000, it is in thousand. Direct material is 8,000. Variable production overhead, it is 2,000. All right, then the fixed production overhead is at 5,000. All right, so these are, now this 20,000 simply indicates that this is the full product cost per unit of this product we're looking at. But these other three, they constitute MC, which is the marginal costing. All right, so meaning in marginal costing aspect, we are only going to consider from 5 up to 2. This is it on a marginal costing, which is 5, 8, and 2. We have those. The fixed production overhead figure has been calculated on the basis of the budgeted normal output. So this is the budgeted normal output of 36,000 units per annum, which is per year. So we can divide that 36,000 by 12 to find what would be per month need be, if you put into the question. And then they're saying you have to assume that there is no expenditure or efficiency variance, and that all budgeted expenditure is incurred evenly over the year. The selling, distribution, and administrative expenses are fixed 120 million. Then variable is 15% of sales. So fixed is just 120 million. All right, this is for the year. Okay, 120 million is for the year. That is, you assume that there is no expenditure or efficiency variance and that all budgeted expenditure is incurred evenly over the year. Selling, distribution, and administrative expenses are fixed is 120 million, variable is 15% of sales. Okay, so this is what they have told us. Now, the selling price per unit is 35,000, and the number of units produced and sold were, so March, we had the units that were produced in March were 2,000 units production, and then in April, we had 3,200 units, and then they only sold in March 1,500 units, and then in April they sold 3,000 units. Here we can clearly see that we can have our closing inventory. Okay, so we produce quite all right. So closing will be what? So our closing here is going to be, we have produced the 2,000 units, and then we've sold 1,500 units, meaning that we can close with 500 units because we've produced 2,000 and we have sold 1,500 units. So we can close with 500 units. So this 500 units will be the opening stock. Okay, so meaning we say opening stock. Okay, opening stock, which is OS. For March, we assume that they haven't told us was 0, and then we produced 2,000 units. Then we sold 1,500 units, so we can close with 500 units. Now, the closing stock for March will be the opening stock for April. So this will be opening stock with 500. All right. And then 500 units that we have opened, the opening stock in April, plus the production of 3,200 units, then we can have a closing stock of, so we can add the 3,200 plus the 500 units that we opened with, that is the 3,700, and then minus the sales of 3,000, then the closing stock here will be 700 units. All right, so in April, our closing stock will be 700 units because we opened with 500 units in April, then plus the production of 3,200, that makes the 3,700. Then we aggregate, we are getting 3,700 minus the 3,000, we are getting a closing stock of 700 units. Now, question requires that prepare the profit statement for each month.
Excuse me, sir.
Yes, please.
Sorry, where did you get that 500 under the month of March and also
Okay,
April?
thank you very much for that question. You see, how many units we've produced? We've produced the 2,000 units. And from the 2,000 units, we only sold the 1,500 units. So we closed with 500.
Oh, okay, okay.
Is that clear?
Yes, it is.
So you're in production, you have produced 2,000 units, then you have sold 1,500 units. So what remains is the closing inventory. So since they didn't tell us that what they opened with, we assume the opening stock was 0, that is OS here in March. So the way it is supposed to be is that opening stock should be added to production, then minus the sales for you to get the closing stock. So you get the opening stock, assume like it wasn't stated here, so assume it was not there 0, then plus the production of 2,000 minus the sales of 1,500, then we get the closing stock of 500 units. Now, the closing stock of 500 units is the opening stock in April. So April, we have the 500. So 500 that we have opened with as stock, then we have produced a 3,200. That comes to 3,700. Then minus the sales of 3,000, then you close with 700 units. All right. So this is about the analysis here before getting down into the computation of the marginal costing and absorption costing. Now, let us prepare the profit statement for each of the months of March and April using marginal costing. So marginal costing is a costing that deals with variable cost of production to find the contribution, like I mentioned. Absorption costing deals with the full product cost in terms of direct and fixed costs. So we can check here. Under marginal costing, we are going to look at it. We are going to look at the direct labor, the direct material, the variable production overhead. So we aggregate. So we're going to use 15 for marginal costing to apply. This is 15,000 kwacha to produce a unit, or 15 kwacha to produce a unit to rebase. Then for absorption costing, it's 20 kwacha to produce a unit. So it's using the full product cost. So for absorption costing, we're going to use the 20 kwacha. For marginal costing, we are going to use 15 kwacha. So this exact example is what is here in these notes for X Limited. So let's follow through this one. It's the same. You can either go the other way. So X Limited commenced business on 1st January, making one product only with the following. So we have these ones. They are the same example which was just copied from here so that we exactly explain fully. Now, the fixed production overhead figure has been calculated on the basis of budgeted normal output of 36,000 units per month. You assume that there is no expenditure or efficiency variance, and that all budgeted expenditure is incurred evenly over the year. All right, selling, distribution, and admin expenses fixed, we have 120 million. This is for the year. So we can divide that one by 12 as we go down in the solution. The variable selling distribution is 15% of sales, which we are going to account for. Then the admin expense, the selling price per unit is 35,000, and the number of units produced and sold are these. All right, so we have these ones. So required, prepare marginal costing and prepare absorption costing. So we can do the workings. So budgeted units, 36,000 units. All right, okay. Now, the units that were budgeted is 36,000 units. According to the question, they're saying the fixed production overhead figure has been calculated on the basis of budgeted normal output of 36,000 units per annum. All right. Now, we have here the fixed cost per unit. Okay, fixed production overhead is 5,000 per unit for one product, one unit. Okay, so the fixed is 5,000. Okay, that is a fixed production cost per unit is 5,000. Now, how many units were budgeted per annum? 36,000. So we can find the total fixed cost for the year. So total fixed cost will be 36,000 units multiplied by the fixed cost per unit, which will give us 180 million. All right. So this is 180 million, because we are saying this per annum, how many units? 36,000. And then the fixed cost per unit is 5,000. So we are getting 180 million here. So this 180 million, this for the year, it's per annum, fixed cost per annum. So we can now find the fixed cost per month, which is 180 million divided by 12 months, which is 15 million. So this is 15 million is per month. Okay. So this is per month. This is what we have. All right. So it's what we are getting. So we are doing per month like this because we are only preparing the absorption costing for month of March and April. That's why we are not accounting for that the entire amount. We are only trying to find the fixed cost per month because you are producing per month. All right. So here you're trying to prepare the statements per month. So we again prepare so now we can go finish the workings. Fixed selling and admin per annum is 120 million. It has been stated here. The fixed selling, discipline and admin expense fixed are 120 million. So divide by 12, we are getting 10 million. So this is the fixed selling admin per annum. This is now per annum was 120. So divide by this one. So this is per month now. So this is it per month. The 10 million is per month. So it's a fixed admin and selling per month. So this is it, what we have here. All right. Okay. So we can now get down to the other aspects. So here, fixed selling and admin per month, it will be 120 million, which is per annum, divided by 12 months to be 10 million. So now we can get to opening stock for March was not there. Production was 2,000. So we were the sales of 1,500, closing stock is 500, which is the opening stock for April, then plus the production. So we can add these two, then minus the sales of 3,000, then we are getting the closing stock of 7,000. All right. Now let us get into the profit statement, marginal costing for March. So we are going to have the sales is we sold how many units? We're supposed to look at how many units were sold in how many units were sold. The sales or units were 1,500. Okay, so sales units were 1,500 multiplied by the selling price per unit was 35,000. It has been stated in the question. Selling price per unit is at 35,000. All right. And then we only sold 1,500 units in the month of March. So we can just put here 1,500 multiplied by 35,000. You're getting 52,500,000. We are looking at variable costs. So less variable cost. Opening stock, which is 0, multiplied by the variable cost of sales is 15,000. Where the 15,000 coming from is coming from here. The variable cost, where we are looking at this amount. So as we add here, it has been rebased. So it's 15,000. 8 plus 2 is 10,000 plus 5,000, 15,000. So that's why the 15,000 is, we are losing it. All right. So we come through here, we compute, we are getting the sales there, the selling price, opening stock for month from here, from this information that has been given here now. We was an opening stock for March was not there. So we multiplied by the variable cost per unit to get the 0 there. Then production, we produced 2,000. All right. So 2,000, we are getting just the information that has been given. 2,000, then multiplied by the variable cost of sales, which is 15,000, which is 30 million. Now, less closing stock at variable cost. So closing stock was 5,000 multiplied by 15,000, which is 7,500. Then add variable selling expense. So variable selling expense will be added from the format which was given here. So you add the variable selling expense to be added here. And the variable selling expense from the question, it has been stated that it is 15 variable selling, and that means is 15% of sales figure. All right. So meaning this is the reason why we are getting to this amount where we are saying 15% of sales, 15% of the sales amount, which is 78, that is 7,875,000. And then doing the addition and subtraction here, we are getting the total variable cost of sales is that amount. Then we can get the difference between these two is what we call contribution, which is 22,125,000. Then less the fixed cost, which is 15 million. 15 million is per month. Fixed cost, we found 15 million. The fixed overhead, 15 million, which should be subtracted. This is per month. All right. So 15 million subtracted, and then fixed selling and admin of 10 million, which we found here from this calculation. So everything else has been computed. So we can now get the net profit or loss. So this is the net loss, which is 2,875,000. So this is the marginal costing for the month of March. All right. Now, getting down to marginal costing for month of April. So April marginal costing. So this question was a comprehensive example because it had 4 statements that were supposed to be prepared. Marginal costing for the month of March based on the month of March and April, and then absorption costing for the month of March and April. So now we can find the sales. It is 3,000. That is for the month of April. We sold the 3,000 units. All right. So 3,000 units is the what we have. So 3,000 units, then multiplied by, so we're looking at sales for April, 3,000, multiplied by the selling price. Selling price is 35,000. So the selling price, so you're getting the sales of 105 million. Then less the variable cost. So variable cost is opening stock, which is 500 multiplied by 15,000, which is giving us 75. This is 7,500. Then add production or add variable. So we are using 1,500 or 15,000 as variable cost. This is the variable cost per unit. All right. So the first one here, we are saying sales was 3,000 by 35,000. So it gives us this amount. Then this one is a variable cost, is 500 units opening stock multiplied by 15,000. We are getting 7,500. Production, we produced 3,200 units, which we should be multiplied by the variable cost. So we are still looking at variable cost because this is marginal costing. Then we are getting that amount. Then less closing stock at variable, we have that one. Then add variable selling, 15% of sales, 15% of the sales figure coming from here. Then we are getting that. Addition and subtraction, we are getting the total variable cost of sales of 6,750,000, and then contribution is 44,250,000. Then the fixed overhead was 115 million that we have already found, calculated there above. Then the fixed selling is 10 million. The net profit here is 19,250,000. So this is about marginal costing. All right. Now, the aspect of absorption costing, we are looking at full costing here for month of March. Sales was we sold 1,500 units. Okay, so 1,500 units, that was the sales. We go back and then multiplied by the selling price per unit. So it's giving us the same 52,500,000. Then the full costing, we should get a 20,000 because we are considering the full product cost. So 20,000. So meaning that we are going to have a zero there. At production, we produce 2,000 at 20,000. So 2,000 units at 20,000 quarter per unit. We have that one. Less closing stock was 500 at 20,000. We have that one. Cost of sales is 30 million. The gross profit was 22,500,000. This is about the way we consider or do it based on this statement is similar to the financial accounting part. We are looking at preparing the income statement. So the absorption costing considers the gross profit, like I mentioned. Now, let's under absorption. Why under absorption? So we have under absorption. So under absorption will be, let's go for the budgeted units. Okay, so budgeted units, we are saying budgeted units were 36,000 units. This is per year. So if we divide 36,000 by 12, all right, we are getting, all right, so if we divide this one by 12, we are getting the amount, which is, so 30,000 by 12 we are getting our production for the month of, so you're getting a 3,000. Okay, so meaning you're getting at 3,000. So this was the budgeted. So meaning our budgeted units were 36,000 units. So meaning per month, we are supposed to produce 3,000 units. But why did we produce the 2,000? So we had under absorption of 1,000 because we produced the 2,000 units here in March, which our budgeted was 3,000, meaning the 36,000 was for the entire year. From here, they're saying the fixed production overhead figure has been calculated on the basis of the budgeted normal output of 36,000 per annum. And then our production here was 2,000, meaning that we were under absorbed here under production of 1,000 units. So that's why we are going to subtract here as we come to absorption costing. So we have under absorption of 1,000 units. Okay, so 1,000 units were units that were under absorbed. Now, those units that were under absorbed, we will have to actually now multiply by the fixed production overhead, to multiply by fixed production overhead of 5,000 kwacha. Because from here we have the fixed production overhead is at 5,000 kwacha, that is per unit. So under absorption here, our budgeted was 3,000 as calculated here. We produced a 2,000. So meaning there was under absorption of 1,000 units in March. So we are going to subtract under absorption. If it was over absorption, we would have added. So add over absorption, subtract under absorption. So here under absorption, it was 1,000 units multiplied by 5,000, which was a fixed production cost per unit. The units that were under absorbed were 1,000. Fixed production cost per unit was 5,000 kwacha. So under absorption was 5 million. Less the fixed selling, which was 10 million, less the variable selling of 7,875,000. So if we can see here, we had this amount, the less variable selling, which was 15% of 52,500,000. Okay, so 52,500,000. This is where the 7 came from. So it was 0.15. So 0. Was just actually so 0.15, then multiplied by 52,500,000. That's where this figure came from. So less the variable selling, less the fixed selling was 10 million. Less the variable selling was 0.15. It was 15% in the question. It was stated the 15% of sales figure. All right. So this is it about how that one came about. So we have that figure there. So our net profit or loss was 375,000, which was a loss. Then similar, getting to a profit statement absorption costing for April, you do the same, where it says sales multiplied by the sales units multiplied by the selling price per unit, which will go to that one. Then you multiply opening stock, which is we can get from the table here. The opening stocks, we're looking for April. Opening stocks are there and the closing stocks or everything. So we are going to have the figure here where we're saying opening stock was 5,000 units by 20,000. We're getting that. Add production of 3,200 by 20,000. So we are getting that amount, less the closing stock of 14 million, of the cost of sales of 60 million, then the gross profit of 45 million, add over absorption. Why over absorption? Because here we produced the 3,200 units, but the budgeted units per month was 3,000. So we overproduced 200 units. So that is over absorption. Then we are going to add the over absorption as we look at this other one. So add over absorption of 200 by 5,000 of that amount, then less the fixed selling of that one, and then less the variable selling, 15% of that amount, 105 million, you have that one. So the net profit or loss is 20,250,000. So this marks the end of the topic, looking at both the marginal and absorption costing. So you just need to pay extra attention to details. So for any queries or concerns, we can still come back for those who are going to be behind. So this marks the end of the topic, so we can end here for now.